Good afternoon. At this afternoon's Intelligence Forum's Who Are You podcast, we're very privileged to have Richard Angus, who's the head of business development at Hardman & Co. Richard, thank you very much indeed for this interview.
It's great to be with you. So I'm looking forward to this. Thank you.
I'd like to start by asking you about your professional journey so far.
Well, my father was the senior partner of a London stockbroking firm. So when I was brought up, there was a certain amount of commentary on the market, and I got very interested. He actually retired before Big Bang. But it's not surprising that when I entered the financial world, I did so after qualifying as a chartered accountant with Pete Marwick Mitchell in London, which is now KPMG. And then I worked as an equity analyst for an insurance company. But then one of my favorite brokers managed to get me a job with a major UK fund manager in 1982. And I joined a relatively small team, but you probably won't remember, but in August 82, the American stock market went wild after a period of inactivity. It just took off. And I was sent to America to find out really what was going on. And this coincided with a technology IPO boom, which was great timing from my point of view, because ever since then, I've been very heavily involved in high growth businesses, not only in the tech world, but also in the life science world, in genomics, which was a massive revolution around the turn of the century. And then I basically swapped jobs as about 20 odd years ago. And I ended up working for a firm in Washington, an investment banking firm that specialized in financials. And if you've ever seen films like The Big Short or Margin Call, that was the world I was actually in. And it was absolutely fascinating. So that basically gave me a great perspective on the market. And we even took two companies, two private banks. We built them essentially for the US government to help with the credit crisis in America. And soon after that, 2011 or so, I basically retired, and for the first time, that is. And that's when I came across Hardman & Co.
So that brings me to the question, what does Hardman & Co. actually do?
Well, it's an interesting question because Hardman & Co. has been around for about 30 years and initially focused on writing independent research on listed companies and distributing the content to a very wide audience of investors beyond the institutional base. What I have to say now, to be very clear about what I'm going to talk about now, is that we have never offered investment advice to investors, and nor do we claim to be offering investment advice. But what we do offer is an independent opinion based on two things. The first thing is that we have very experienced analysts, and they are the IQ, if you like, of the firm. And then we have a team of people like myself that have had significant experience in banking and investment management and other areas of the financial world, but are very aware of how investors think, how sentiment changes, which is incredibly important now. So we can give a very balanced opinion to a company about how other people may be looking at them relative to what they might be thinking in their own boardroom. And why this is massively important is that in the last few years, we have extended our practice from the public markets, listed sector, into the private company world. And we started doing that by getting involved with reviewing EIS managers. That led us into another world of offering independent assessments of private company valuations and strategic help with boards of private companies. But as I say, in no case do we say this is investment advice. We offer an opinion that might help them make a better decision than they would have made had they not actually known about what we do.
Clearly, you've earned the title City Veteran. And, well,
yes.
True.
I know,
Now,
yes.
now, the thing about it is that I'd like to ask you, since 1982, what are the biggest changes you've seen in the square mile
Well,
in 43 years?
well, Pre-Big Bang, which was in 1986, and I joined the city in 1982, it was very much a London-centric community based largely around activity in the London stock market from the way that I was involved and the community of people. The city lunches were incredibly important, and there wasn't really a huge amount of focus on overseas opportunities in the company I worked for, but that was about to change because once we had Big Bang in 1986, we had foreign ownership of UK institutions and there were big technology developments. The world changed dramatically. And rather than working your way through a career based on how long you'd been there, etc., it was a much more open market. And I think that's the big difference. Now, there's also been significant changes in the regulations as well. And so the structure of the whole working world is completely different. I would say that some people have said that maybe the London market hasn't kept up with some international developments, but that's not really what we're going to be talking about today. But I think you have to be aware that once you open to the world, it does take quite a lot of ability to absorb everything else. But I still think it's a fascinating place to work.
I mean, one of the things that you'll have thought about, I am sure, is that when the word UK growth and productivity is mentioned, which it continually is, you might have a perspective, and I appreciate it's your perspective, but that's what this platform allows you to do, is have a perspective. What do you think we should do? What policy changes would you like to see take place to improve UK growth and productivity?
The first thing is that we've always had a fantastic amount of entrepreneurial talent in this country. And whether you want to talk about it from a technological basis or in other areas, and for a lot of these companies to grow, especially in a global marketplace, they need external funding at some point, and they need to be able to move relatively quickly. So we're talking here, there's an awful lot of intellectual property, for example, and in an optimistic market, intellectual property is really almost a cost of doing business. It's protecting your brand or whatever you want to call it. When things get more complex, which is what they are now, less clear, and there's less confidence around, it's very much more difficult for these companies to necessarily raise the money when they need it at a price that they think is reasonable. And we're going through that period at the moment where this year, I would say, you've had investors have largely in smaller opportunities have largely had a risk-off attitude, but businesses go on for 24 hours a day, 7 days a week. And what we need to do, we need to basically reconnect those two sides of the market. And the thing that connects them is confidence in each other. Why would I invest in a company if I don't really understand what they do? In a bull market, it's more the momentum takes the shares up in price or whatever. Liquidity in private markets is another issue, which we are currently addressing. And then the third thing is valuation. Because as an investor, I do want to know about a company, but I actually want to know how I'm actually going to make a return over what period. And if companies have got a short-term objective because they are wondering how long the cash they have in the bank is going to last, in a bull market, that doesn't really matter because you'll raise money because you're more successful. And next year, we're not worried about raising more money. In this sort of market, there is an element of risk that if we raise money and we have a delay in our business plan, you might not actually make it because you may run out of money. So we call this room risk, running out of money risk. But that needs to be addressed up front by companies. And the issue we are talking about in many cases is that a company may not understand precisely what investors need to know from them, but they're very happy to tell them more and more about what the company does. They need to sit and look on the other side of the table and saying, if I'm an investor, can I leave a meeting better informed about whether I should make an investment decision relative to what I've just heard or not? So this indecision element is something that we're addressing.
So another question I'd like to ask, and maybe there's a commonality between the previous question. is how would you grow a smaller business into a medium-sized business, or a medium-sized business into a bigger business? What ingredients do you think is it the same again, or what do you reckon?
Well, I think there's a difference between startup and then building up to the next stage. So when you're starting a business and you get to the stage where you have gone through the contacts in your family and friends and the financing, you have to move into a world where you'll need external investors that you've never met before. So that has to be dealt with. And then you get to a stage where you're now expanding the business because it's established, it's got revenues, it's got almost a track record that you can look at, it's got clients. You move into another area where to expand, how fast do we expand? Do we go internationally? Do we focus on certain areas? And then after that, you get to the point, well, what happens to our business next? Are we going to be sold to another company? Do we sell to someone? Do we expand? Do we go and build the business, but also buy other businesses if they're available? And this is basically the phase we're in. The problem is, unless you can get started, you're never going to get anywhere. And I sense there's quite a lot of ambitious companies in this country who haven't made necessarily a good a start to life as they might have done. But there are people you can go to, there are fund managers, there are sources, but you have to be in the network so that you can tell people, enough people, your story at the appropriate time. But again, the valuation has to be sensible. Now, the good news is that there's a huge amount of data available, if you know where it is in the UK market, to help support other people's transactions that will give you, as a CEO of a business, perspective. But you have to understand that your shareholders own the business, or the ones that are involved. They have to be treated and communicated with in a very consistent way. And what you can't do is close the boardroom door if there's a problem. And we're talking about private companies. Now, the other good news is there's more effort being made to provide liquidity in private companies through various platforms. And you will have heard the London Stock Exchange Group talks about Pisces. There are other companies like Asset Match and JP Jenkins. So as an investor, you think, well, in a public company, I can just sell the stock. I just ring up my broker and sell it. In a private company, you think, well, actually, I need to sell the stock, or I want to sell it. What do I do? So there are ways of this is the market we're looking at in great detail, because we think there's a big opportunity. And what this all means is it raises investor confidence. It's not only about the company, but if I have to sell or something happens, do I have an exit point? So I'm not locking myself up forever. Even though when I entered the transaction, I was expecting to be on board for 3 to 5 years or maybe more.
That brings me to the last question. And it's not a politically loaded gun, just in hardcore business terms. What did you make of the budget?
There were certain things said in the budget that were very helpful towards entrepreneurial businesses in the UK, such as raising the amount of capital for EIS companies, or companies that qualify for EIS. That's very important, because companies need time and money, and they don't necessarily succeed overnight. I think the thing that what didn't really come across particularly clearly was that I was hoping that would be more of an optimistic basis for 2026, in the sense of growing people's confidence in next year, and therefore would remove some of the investor indecision, because a lot of investors this year, they're not in a hurry. If they don't know what to do, they'll wait. But if we all wait, nothing's ever going to happen. And I think that is something that we need to address, because otherwise there's going to be a problem. And one of the problems is going to be unemployment is going to take I would say, a very unpleasant journey. And that's going to impact a number of things. So it's very much saying, well, okay, interest rates are coming down and this and that. But I think basically an investor needs to feel confident, but also a company, if you're running a business, you need to feel confident, because otherwise you'll cut costs or you'll reduce your growth potential. And that's not necessarily good for the employment market. And yet we need to give people an opportunity who are, ambitious to participate in the economy. So I think that's something that we will have to see what happens next year. But I was just a little bit disappointed that there wasn't a little bit more of a sort of an enthusiastic overview that next year could be a lot better than this year, because this year's been very challenging to many companies, and last year was also quite difficult. But I think there's a number of things that are quite positive. If you look at what's happened in the American stock market, etc., it's not as though the world is completely dead. But I think we need to get the focus back on UK entrepreneurs and making sure that the right people have a chance to succeed, with the right shareholders who pay a fair value to be involved.
Richard Angus, a great privilege. Thank you very much indeed
for
this interview. Thank you.
Thank you. Okay. Thank you very much, Harry.